The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A warm welcome to this Wednesday edition of Squawk Box with Karen Cho, myself, Steve Sedgwick, and these are your headlines. So Nvidia plunges nearly 10% and wipes almost $300 billion off its market cap. That is the biggest single-day value decline on record for an American company. Whilst Wall Street tumbles to its worst day since the early August rout. Well, Japan's Nikkei leading the losses in Asia as the sell-off spreads. Semi-conductor stocks tumbling across the board with TSMC, SoftBank, Samsung and SK Hynix all feeling the pain.
US factories remain in contraction in August, with ISM manufacturing data coming in at 47.2. Former Fed official Loretta Mester tells CNBC the market needs to look beyond September's Fed meeting.
More important even than the first cut is sort of the path of rate cuts coming after that, and we're going to get information from the Fed on that because we're going to have new summary of economic projections. So I think that's going to be really one of the key pieces of information coming out of the meeting.
Bank of America joins the list of lenders casting doubt on China's 5% GDP growth target, while Caixin PMI data points to a slowdown in services growth.
And adding to the pain for the bulls, crude prices extending losses after plunging more than 4% on Tuesday to their lowest levels of the year. This on expectations of greater supply out of Libya. This is all about you, by the way. Have you noticed, every time you're back, we get a wobble.
You get news.
I came back a couple of weeks ago, glacial, record highs again as well. But this is down to you, Karen, by the way.
It's true, you do get news slow
that is my market analysis, and I can walk away now.
It did feel like it was too good to be true. We had a market event, and then everybody just got back into stocks. And we've been asking the question all week, should you be moving to the sidelines? Is it right to be so invested in markets at this point and to be so comfortable, given we've had somewhat of a wobble on market? So Nvidia stock, this was the big moving event. As you take a look at this stock in particular, down almost 10%. The size of the losses, eye-watering. But is that just part and parcel as we talk about a stock that's 3 trillion or 2 trillion in terms of market cap, that when you do have selling, and they are large moves, you see a large amount wiped off the stock, nearly 300 billion in terms of movement yesterday. Over the course of the last 7 days or so, there has been movement, and you can see now to the tune of 15% to the downside. But take this back a couple of sessions, and it was actually the stock leading the recovery. So as we talk about some rotation after the market event in August, there was still momentum in AI names like Nvidia leading the charge higher. So that came to a stop yesterday as we saw the extent of these losses. But it wasn't just Nvidia, it was other chip stocks too, where you've seen some of the selling. And it does tell you a story about AI not being immune to economic events, not immune to concerns around a broader economic story. And this is quite different to the FANG plus stocks that led the way out of the crisis back in 2008, 2009. Some of these names were immune to some of those economic stories that we were seeing unfold. So Qualcomm down nearly 7%. Intel, it has had a mare in recent weeks and months, 8.8% in the red. Marvel down 8%, Broadcom shedding 6%, and Advanced Micro Device down 7.8%. So right across the space you saw selling. And for me, what's interesting, the Philadelphia Semi-conductor Index, this was an area where investors saw an opportunity and they went for it. On the back of the August selling, we saw this index very much in reversal, 4,700 roughly where we were at. We climbed back through the 5,000 level, and now with the selling yesterday, back pretty much to the levels we saw on the back of that sell-off in August. So that nimble footwork, did it look like being dynamic and getting back into the trade was the right move. At this point, you could have done nothing and you would have been seeing the same price on the Philadelphia Semi-conductor Index. Quite a mouthful, isn't it? Let's take a look at the US markets as a result. And more broadly speaking, you can see the Dow down 1.5%. And the rotation story has lifted the boat for the Dow. We saw that right into the Friday session. Another record level that we saw on the index as it closed up shop before Labor Day, but down 1.5% in session yesterday. Bigger losses felt elsewhere thanks to that tech story, and you can see it on the Nasdaq down 3.25% versus 2% coming off the S&P 500.
No doubt about it, and Karen's brilliantly gone through that. The catalyst for the sell-off was in technology. It was about Nvidia. It was about this DOJ subpoena, which some people may have got wind of, and obviously after hours came off again. But if it is all about that, then why weren't the rivals that Karen just mentioned rallying? Because if this is about a monopolistic position of Nvidia, which the DOJ has yet to prove its case, by the way, then surely the others would be going up when Nvidia is going down, because obviously it's a net zero sum game. Just chucking that one out there as well. But the other point was, and Karen's again graphically said that rotation didn't help you much yesterday because we saw all boats lowering on that tide. But the fact of the matter is, I think you all got a little bit too overwrought, and I want to know why the market is reacting so disproportionately to actually a steady stream of data. Now, some of you out there were looking at this ISM, the PMI manufacturing, and getting really, really worried. US macro watchers got a double dose of bad news on Tuesday, two separate manufacturing gauges pointing to contraction. Now, this is the one that a lot of people focused on. As Karen mentioned in the headlines, the ISM's PMI reading came in at 47.2. That was up from July, but short of what the analysts expected. I'll come back to this. Meanwhile, the S&P and its own PMI reading eased to 47.9. Traders upped their bets on a fifth, of course they did. Knee-jerk reaction. They upped their bets on a 50 basis point move from the Fed next meeting, with the probability of a larger cut up to 11 percentage points higher since yesterday, according to the CME's Fed Watch tool. Right, let's take a break. Let's have a little think about this. I've done something for you. I've gone through the ISM Institute of Supply Management PMIs for everyone. 18 pages I went through for you lot this morning, so that I can just add to you a little bit of comment on this one as well. There is no doubt about it. It is in contraction territory. Ergo, it's below 50. But this is part of a series. It is nothing new for you out there. This is my point. If you're selling on the back of this, then why? Because it's part of a steady stream of data. For instance, it's the 5th consecutive month of a decline, so nothing new particularly there in the trend. It is the 21st out of 22 declines that we've seen over that period as well. It was better than July, as I just mentioned there as well. And this is a key point. I'm not trying to, by the way, put a shiny story on something which is tough. I'm just saying it is not particularly new news for you. And this is the point that ISM are keen to point out. And I saw it from other copy as well this morning as well, so from the analysts as well. If a manufacturing PMI is above 42.5, and this is actually a really interesting comment, which I wasn't aware of. If a manufacturing PMI is above 42.5 over a period of time, which we have been, generally indicates an expansion in the overall economy. So whilst there is declines in the manufacturing ISM PMI, and this is why I wanted to dig into the weeds for you, it doesn't mean GDP is declining. It actually means GDP is still in expansion. That is a really important point. Contraction in an ISM PMI manufacturing, I don't make any excuses for going to the weeds on this one, doesn't mean the economy is contracting. And I find that very fascinating as well. In terms of the individual comments as well, just pull out a couple for you, because actually it was very interesting looking at what the individual respondents said, and it was mixed. Some are saying there is a sluggish new order intake at best. Others are saying our orders are slowing. Others are saying new orders continue to be strong. So it is a very patchy picture. Quick word on the Treasury. I know Karen's going to come back in on this one as well. 10 years trading at 3.8, as indeed is the 2-year as well. Karen.
Fundamentals at this point, do they matter? Because we've seen in other moments where the narrative has been investors just discounting all the bad news, buying stocks day after day, and we've gone from record high to record high. Now we've even had news flow out of Nvidia the other week. It didn't count either. The news flow wasn't that bad. We saw, 30 billion in revenue for the quarter. 80% sales growth in the current quarter is what it's saying. So the news wasn't bad. There's a lot of good news, in fact, in the sector, but none of it's mattering at this point because sentiment is so skittish. And perhaps this is the messaging for the Fed as we bring back some of those expectations for a 50 basis point rate cut, that even though we've had record after record on the stock market, is it a false high? Is it a sugar rush? Because investors are so scared about missing out on big market moves to the detriment of their performance on a quarterly basis that they're moving quickly into some of these trades if they see an opportunity.
Volatility in the market is not being matched by volatility in the data. The data is fair. This is, if I made one point today, it is that the data is fairly consistent, but your reaction is outside. So is it because of A, bots in the market or algorithmic trading, B, less liquidity, C, unhelpful valuations, D, travelling and arriving, i.e. a lot of people are saying we've had a good run. Even with this move in Nvidia, you've still made over 100% this year as well. Or is it a combination of all of the above, plus the fact that by and large, for instance, there was no offset on the oil price. We haven't even talked about that. The oil price went down, concern about Libya production again. All those geniuses who said we were going to go to $110 a barrel this year, they're all wrong so far and looking like they're wrong. So there was no offset. There's the oil price again, falling. Again, WTI crude, it's back into rebuilding the strategic reserve territory below $70. So there's a lot of different things going on, a confluence about where's the China growth? We're all worried about that. So there's a lot of little things which are hitting that sentiment.
A quick word on timing. We've got the non-farm payrolls Friday. There's a view you don't want to be on the wrong side of the trade around that data. It's such a big data point now for the market. So we've seen a move towards defensives. What happens in terms of investors getting back into the markets? Because we saw that in the back of August. It was very fast moving in terms of getting back into that trade. Nvidia up 25% in the span of that 3 weeks that has passed since that market event. What do we see this week? Do you have to wait it out now to non-farm payrolls on Friday
before I get to Adrian Lin, who's waiting very patiently in the wings as well? One more comment on this, because I find it fascinating, this whole... Why would you sell the FTSE, the DAC, the CAC today, this morning? It's cooled off, it's cooled down. Why would you sell it on the back of the US, apart from sentiment? Because we've got our own economic fundamentals, we've got our own interest rate dynamic, we've got valuations which are historically low compared to... I'm not saying that people won't sell off, and yet maybe it's totally logical.
A global demand story now?
Yeah. I get that. You know, you sell her down a portfolio and all this as well. But the fundamentals of the ISM and Nvidia have got zip to do, really, with European equities.
I don't know, you put the US together with the China story, and do you take a step back on the global picture which impacts Europe?
I'm just saying the knee-jerk is there. It's inevitable. And of course, it's historically, in my 36 years in the city, it will happen. I'm just saying, do you need to take it with a pinch of salt? Because some of these are very, very specific factors to specific sectors and to specific economic nuances as well. Anyway, look, we've got to move on because I've taken half the show. The Nikkei and the topics are sharply lower in trade today, led by chip stocks. Lynn, who is the most patient person at CNBC, has been waiting. She's on an offset, not behind me. Lynn, lovely to see you.
Good morning to you, Steve. And as you guys have been seeing, we're seeing Japanese stocks continuing to decline. The Nikkei 225 is at around that 3-week low at the moment and has fallen by 4.5% as we near the end of the trading day. The sell-off certainly very much concentrated in tech and semiconductor related plays, but it has been broad-based, because if you look at the topics, which is much more representative of the broader market, it has also fallen by 3.9%. If we look at MSCI Japan Tech, that gives us sort of the broader picture of tech-related plays in Japan. It's down around about 5.4%, but some of those key names that we watch, like Tokyo Electron. So we're seeing basically companies up and down that semiconductor supply chain getting hit hard. Tokyo Electron is a chip equipment company, down there close to 10%, so getting close to Nvidia territory falls. SoftBank, which of course is an investment company but very much invested in ARM, has about 80% share, down close to 8%. And Advantest, which is that leading chip testing equipment company, also falling by more than 8%. Certainly it's off the back of a lot of the things that you guys have covered. Wanted to add in there as well, if we look at the yen as well, because we've seen the steady appreciation of the yen really in the last few weeks, and the yen continuing to be bid today. It's at 145.07, and certainly that is having an impact as well on the broader market, because unlike perhaps South Korea or Taiwan, Japanese stocks a little bit more broad broader. Certainly, if you look at the auto stocks, that's one of the heavyweights for the market. They are basically all falling in line with the share average. Nikkei 225 there, Toyota, for example, down 3.3%. Also, we're getting the impact in terms of the crude oil prices stateside. I know it's moderated, but certainly the worst performers are energy-related and oil-related stocks in Japan. Of course, that is speaking to some of the concerns in terms of global growth vis-a-vis China as well as the US. Back to you guys.
Lynn, thank you very much for bringing us an update. The US Justice Department reportedly hits Nvidia with a subpoena as part of its antitrust investigation. That's according to Bloomberg, which says officials are probing whether Nvidia made it intentionally difficult for clients to switch to other suppliers or penalizes those that use a range of different AI chips. Nvidia shares fell further in after-hours trading, adding to Tuesday's sell-off. Arjun joins us with more on Nvidia and the big moves we've seen in after-hours as well as during the session yesterday. Let me just pose a question. DOJ versus Blackwell chip execution. Which matters more for the market at this stage?
Well, according to the share price at this point, it looks like it's the DOJ. I think, Nvidia put some of the issues around Blackwell to bed in the last earnings call, saying that it's still on track to be delivered in a timely manner. I think right now the market's very concerned. I think first, the fact that Nvidia has had this huge run-up, as we've been speaking about, for so long, and if this DOJ investigation could derail it in any way. The DOJ's concerns, according to, first this Bloomberg report, but also a report we had a couple of weeks back as well from The Information, stem around a couple of things. One of them is whether Nvidia has effectively abused its dominant position in this particular market around GPUs for training AI chips. And The Information said the DOJ is looking at a couple of things. This was a report from 2 or 3 weeks ago. Did Nvidia pressure customers to buy extra products beyond just sort of the server stacks into, say, networking equipment as well? And does Nvidia charge higher prices if a customer then wants to go on and use rival chips such as AMD? But the key here, I think, at this point, and I think you alluded to it earlier at the top of the show, is the fact that Nvidia was the first mover. It's not only come out with the hardware, but it's come out with the CUDA language, programming language, which has become so key to using these chips as well. And so it's built up a very strong position in the market in the face of the fact that there's no competition, or there hasn't typically been competition for so long. It's only really this year AMD has stepped up efforts in this space in terms of the GPUs for AI training. And yes, some of the other hyperscalers are sort of designing their own chips, but there hasn't been a huge amount of competition at this point.
Ecosystem matters, right? If we think about it through the idea of Apple and just how that ecosystem has worked for many years, while there are competitors, and you can argue there's a very strong competitor in the room being Android, a lot of users have opted for Apple because everything works and you stay very much locked in that system. I think this is what the regulators are concerned about, aren't they? That people will spend the money, they'll pay up for these GPUs, they pay up for access to these chips, even though there are other competitors, because it's all too complex and it's just simple to buy one big stack, one big system that works for you. The end result is that consumers pay more because a lot will be derived around this AI universe that companies are creating and paying more for potentially.
Yeah, you're absolutely right. And I think the Apple comparison is perfect, because the regulators there are concerned that Apple's locked everyone into this sort of Apple ecosystem, and there's no choice.
They haven't done anything, have they?
They've already done anything. They've built a product that people like.
I mean, funny enough, I saw an old clip of Steve Jobs, a really old one, being questioned about what they'd done. It was like early 80s. Anyway, it's amazing. But despite the fact that Apple, as you quite rightly say, it's hard to get out of the Apple ecosystem.
The difference is that was our choice as a consumer, and this could be a choice for the consumer by default, because if the hyperscalers are all buying these GPUs from Nvidia and spending more money, and it drives up the overall price of AI adoption, then we as the end consumer have to pay for that price down the track.
Aren't the biggest users the people who are building these big server centers?
But we are the end consumer eventually. We are the ones that pay for the AI products that the hyperscalers
but if your customers
come up with.
Meta, Apple, Microsoft.
But that's the customer now. We are the customer.
But they are
Meta.
the big customers who are driving the demand,
aren't
they?
But the first customer, not the second one. So the second customer is us. So this is my point, that if the first customer...
Yeah, but that's such a derivative down the line, because we buy a suite of products. We don't buy an AI product off those companies.
But that suite of products becomes more expensive because of the cost of investment from the hyperscalers.
I think there's a couple of points, though. The word choice is really important, and this has become something that's become key to all of these sort of antitrust investigations. It's, yes, you can build an ecosystem, fine. You can build your products, but that doesn't mean you can then block rival services. So in the case of Apple, one of the things that regulators globally are looking at is their App Store, and we saw that in the European Union. They said, well, okay, it's fine, you have your App Store, but that doesn't mean you can then not allow people to use a different App Store.
On that store,
and
like
their prominence
you charge them. And can I ask another silly question? I've asked it before at the wall, just rhetorically. Why, if this is all about Nvidia's DOJ issue yesterday, well, why didn't all the other stocks rally? That's why this doesn't quite work. That's why I love the narrative from the scribes out there, but it doesn't work, does it, you lot? Because if this was about the DOJ, they should have all been rallying because they get a better competitive position.
Yeah, absolutely. Yeah.
It's an economic story, isn't it? Because of the deep amount of money required to fund AI. If the economy looks like it's going in the opposite direction now, then you're not going to see the same level of investments. And I think in recent weeks, there have been questions from companies as to where they can save money. And a lot has gone into AI without questions, because it seems for many CEOs, you don't want to be left behind the race. It's moving very, very quickly. You'd put all your tech investments in that basket. But now I think a lot is stepping back and saying, well, if there are hallucinations, there are still issues with AI. And we saw a tech event recently in terms of execution. There was an infection for a third-party site that caused problems. I think a lot of CEOs are saying, do we want to be investing at the same pace that we thought at the start of the year? Or can we also save money around AI if we're going into an economy that is slowing? Do we need to be concerned about those AI investments now? And could they actually happen at a slower pace?
So to add to Karen's question, is the market rewarding, this is, you don't know the answer, by the way, is the market rewarding you for spending on AI, or not spending on AI, or spending a little bit on AI, or actually showing you can prove you can make money from AI, which is the golden...
The answer is depends who you are, right? If you look at the earnings season we've just had, the big tech companies, Google, Microsoft, Amazon, etc., have said we're going to continue to spend. They've upped their capex significantly in the quarter just gone, and they're continuing to do so because they keep buying all this infrastructure. And so, and the market's fine with that because they're seeing that investment. Perhaps other companies, not as with less deep pockets than these big tech giants, won't be rewarded as much because at this point, it's very clear the returns on those AI investments are not quite clear yet. If you're not a picks and shovels company at this point, and perhaps if you're not a Microsoft or a Google at this point, and your cloud business is growing at 30%.
So the big question for me is what happens now with some of the price targets, because we're getting very close to price targets that are seen as attractive entry points for Nvidia. Do we see investors step in on a long-term buying opportunity? And this is what we heard back with the August meltdown. If you're buying for the long term, you've got an entry point here. Of course, it's very difficult if you're seeing gyrations around these target prices on a short-term basis. But that's my question today, whether you get those price targets and whether investors step in. Arjun, thank you very much. Ahead on the show, China's services sector grows less than expected in August despite a summer travel peak. We'll be discussing the health of the world's second largest economy next. Plus, the Volkswagen gears up for a union showdown after warning of possible plant closures. Will be live in Germany. And we'll be speaking to JP Morgan's head of EMEA Leveraged Finance Capital Markets, Ben Thompson, live from the bank's annual European High Yield and Leveraged Finance Conference. That is at 8:30 CET.
CNBC Connect is back in Bangkok, Thailand. Join the world's top entrepreneurs and C-suite executives for an invite-only leadership retreat. On the agenda, powering innovation and growth in Asia. Is AI transforming industries and creating opportunities? And get insights on building sustainable and resilient businesses. Be part of Managing Asia Live. Network and join an interactive brainstorm session. CNBC Connect, powering innovation and growth in Asia on September 4. Register now.
Bank of America cut its Chinese GDP growth forecast to 4.8% for the year. That is down from 5%, citing a loss of momentum in recent months. The lender has also trimmed its estimates for 2025 and 2026 by 20 basis points to 4.5%. Chinese services activity posted a 20th straight month of growth in August, according to Caixin PMI data, which came in at 51.6. That is weaker than expected and well down on July, as service sector employment slipped from expansion to contraction. Wei Ya joins us now, China economist at SocGen. Thank you so much for joining us. I just want to bring up these forecasts from Bank of America. I think the market has been questioning just what that growth story looks like in China, but to see it in black and white now in an analyst forecast, which is a movement to the downside, not just for this year, but also for coming years, it suggests that China is not getting a grip on this momentum loss. Just weigh in on what we're seeing.
Well, so the recent data coming out of China definitely suggests that the growth momentum is weakening. And then at the same time, we're watching policymakers remain very timid in terms of supporting the economy. So for that reason, it is very natural for everyone to revise down the forecast. I think the key question here is, how much more policy support we'll get. It doesn't look sufficient right now. It is stepping up. And maybe it's also something about the U.S. election risk here that Chinese policymakers are worrying about.
I want to pick up on that point around external demand and external forces, because that is something now that's come on top of the domestic problem that China is suffering. In this context, policymakers before have stepped in. China has come to the rescue of the world before, we've seen in previous crises, but it does have so many homegrown issues now. What does it do in this context? What are the levers it could still deploy?
Well, they have a lot of options, but they have been super reluctant to do anything big. It's not the same policy mindset, certainly, after the great financial crisis. There's absolutely no appetite to save the world, because if you look at the message from the top, the focus is on productivity, supply side. This is what China is doing very well at. The problem is there is not enough domestic demand, and there's going to be more trade tensions. So domestically, they can whip up fiscal support. They haven't done anything. They have done, let's say, very, very little. They can push more on the housing. They can do things. They're just doing very, very slowly.
Why would I, as a Chinese consumer, as a stunningly effective Chinese saver, spend my savings, given everything I've been through as a Chinese consumer over the last couple of years? The Chinese save more than most people on this planet. Extraordinary personal savings rate, somewhere in the region of 40% plus. I can't see a good reason why those hard-earned savings will be spent in the next year or so. You can't persuade people to spend when they've just had an existential shock on their property.
Yeah, totally. That's a primary reason for the high saving rate getting even higher. There was the wealth shock is super negative coming from the housing sector. So actually, the first order of business for the Chinese government in terms of supporting consumption is indeed to stabilizing the housing sector, the housing prices. We're still not there yet. But the market has fallen a lot, right? So the question is, can they speed up some of the support further and faster? Yeah.
So obviously you're the China economist, but you must look at the broader ramifications. China being a nation of savers rather than adopting a more Western style of spending as well. That has ramifications, of course, at a policy level, and we're seeing greater tensions. And you alluded to political tensions. I can't see any way this gets any better in the short term if China has to adopt a more aggressive export strategy. And as such, tariff demands grow in the Western consumers as a response to that as well. This can't end well, cateris paribus, with all things being equal, can it?
Well, they're already having a very aggressive export strategy. When you think about it, it's not exactly directly for exports. It's because they're focusing everything, all the policy support, pretty much only on supply side, and they're depressing demand side with a lot of other policy. So it's a consequence of their strategy. And we're seeing China running massive manufacturing trade surplus here. And we're seeing trade tensions already ramping up. Actually, I think, now that the trade tensions are ramping up, and possibly with Trump, if he wins, it could ramp up even further. That could put necessary pressure on the Chinese policymaker to do more course correction.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.